Good morning, Tina Pries here, founder of Pries Capital Real Estate. Let's start exactly where smart decisions start. Market leverage. Our Real Estate Action Index answers one question. Who has the advantage right now, buyers or sellers? And the way we interpret it is simple. Below 30 is buyer leaning, above 30 is seller leaning. This week, the median list price in Myrtle Beach is $474,999. And our action index is hovering right around 30, essentially unchanged from last month. Inventory is also steady at about 930 active listings. That combination, flat index and steady inventory, means the market has reached a short-term stasis point. In plain English, sales and supply are moving in a stable rhythm, and pricing tends to stick until something breaks that balance. But here's the key. Inventory is still low enough that Myrtle Beach remains slightly seller-leaning, at least for now. So the single most important thing I'm watching is whether the action index lifts and stays elevated. If it does, that's the early signal demand is strengthening. And in a low inventory market, stronger demand typically pushes prices into an upward grind again. If it slips, buyers gain leverage through time, concessions, and price discovery. Now let's go to supply, because supply determines how much negotiating room buyers truly have. The headline on this slide is important. Inventory is still 23% below 2019 levels. That's why even when the market feels calmer than 2021 to 2022, it doesn't behave like a full buyer's market. There simply aren't enough homes to create widespread price collapses, especially in the most desirable pockets of Myrtle Beach. This week, active inventory is 930, down 1.5% year over year. And on a 3-month smoothed basis, inventory is 923, down 2% year over year. What does that mean? It means we are not experiencing a surge of new supply. We're in a market where supply is tight and slightly tightening, which helps keep a floor under prices, especially once demand shows any sustained improvement. For buyers, that's a reminder. Your best leverage doesn't come from waiting for inventory to flood. It comes from targeting specific listings that are stale, overpriced, or have clear condition issues. For sellers, tight supply is supportive, but it's not a blank check. You still compete against the best alternatives available right now. Now we pivot to demand. And the best near real-time demand indicator is pending sales, because pendings become closings. This week, pending sales are 478, down 5.5% year over year. And when we smooth the trend over 3 months, pendings are 395, down 16.9% year over year. That's the story. The market isn't collapsing, but demand is still soft in the broader trend. The weekly number can look okay, but the 3-month delta tells us demand has not fully re-engaged. Practically, this means the next 30 to 60 days of closings are likely to remain choppy, and that's why sellers are more sensitive to presentation and price than they were in the boom years. For buyers, softer pendings mean you can negotiate more effectively, especially on homes sitting longer than the market average. For sellers, it means you should not assume buyers are lining up. You need a sharper offer pricing strategy, credits, and confidence building. For investors, softer demand means longer exit timelines, unless you're buying at a basis that makes sense even with slower resale. The key takeaway here is tight supply is supportive, but it can't carry the market alone. Demand has to participate. And right now the 3-month signal says demand is still working through affordability and confidence. This next slide answers the question. Are sellers re-entering the market or still holding back? Weekly new listings are 49, down 19.7% year over year. On a 3-month delta, new listings are 51, down 8.9% year over year. That's not a flood of sellers. That's continued restraint. And this matters for Myrtle Beach because our market has multiple demand channels: primary homeowners, second home buyers, relocation buyers, and investors. When seller volume remains muted, it keeps inventory tight and protects pricing in quality submarkets. But it also means buyers will concentrate competition into the best homes, the ones that are priced right, staged well, and located well. For sellers, low new listing flow can be an advantage if you position correctly. But if you overprice, buyers won't meet you later. They'll wait you out, especially if rates wobble. For buyers, fewer new listings means you need a tighter search strategy. Act decisively on good inventory, and negotiate aggressively on stale inventory. This is the truth slide on pricing because it separates what sellers ask from what buyers agree to. On a 3-month delta, The median listing price is $469,900, up 4.4% year-over-year. The median pending price is $449,900, up 4% year-over-year. Here's what that means. The market is not crashing. Prices are holding, but with tighter negotiation. The gap between list and pending is where concessions live. Closing costs, repairs, and occasional price adjustments. And as we move into spring demand, this is the question. Does demand lift enough to pull pendings higher, or do sellers have to keep meeting the market? For buyers, this environment rewards discipline. You can still negotiate, but you need clean comps and clear rationale. For sellers, it's a warning against hope pricing. The market will reward the homes that are correctly priced for today's affordability, not yesterday's headlines. For investors, stable year-over-year pricing is supportive, but only if carrying costs don't eat your margin. Days on market is the market's honesty meter because it reflects buyer urgency. Weekly average days on market is 126, up 6.2% year-over-year. On a 3-month delta, days on market is 127, up 14.3% year-over-year. So even though prices are stable, the market is taking longer to clear. That gives buyers time, and it forces sellers to compete harder on the details, condition, photos, showing access, and pricing. Here's the strategic point. When days on market is rising on the 3-month trend, the market rewards preparation and punishes complacency. Buyers can do second showings, negotiate repairs, request credits, and avoid rushing. Sellers should treat the first 10 to 14 days as their prime window. If you miss it, you often end up negotiating from a weaker position. Investors should view longer days on market as opportunity and risk. Opportunity to negotiate a better basis, risk because longer hold times increase carrying costs. Price reductions tell us how sellers are feeling, confident, or pressured. This week, 44.2% of properties have taken a price reduction, up 2.5% year-over-year. On a 3-month delta, it's 46.6%, up 9.7% year-over-year. So here's the interpretation. Sellers are adjusting more than last year, and the 3-month trend says that adjustment is becoming more common. That's consistent with a market where demand is softer and days on market are higher. For buyers, more price reductions often mean more leverage, especially when combined with longer days on market. For sellers, price reductions are not a failure. They're a market response. The mistake is doing small, repeated cuts. One decisive adjustment with improved presentation typically works better than death by 1,000 cuts. For investors, price reductions are where value shows up if the fundamentals are right and the carry costs are controlled. This is the variable that can change the whole picture quickly. Mortgage rates. The weekly U.S. 30-year rate is 5.98%, down 11.5% year-over-year. When rates approach 6%, it's not just math, it's psychology. More buyers qualify, and more importantly, more buyers feel comfortable taking action. But the phrase "not fully absorbed yet" is the key. Housing data lags. Rate moves first show up in lender calls and showings, then pendings, then closings. So what we want to watch next is whether pending sales begin to firm up over the next several weeks, because that would confirm the rate improvement is pulling demand forward. For buyers, this can mean competition returns for the best homes, so be ready. For sellers, it's a window. Price correctly and capture demand before it fades. For investors, lower rates can improve exit liquidity, but don't assume rates keep falling. Underwrite for stability, not perfection. So what does this week mean in one sentence? Stable prices, tight supply, soft demand, but the rate environment is improving, and that can change the tone of spring. Supply remains tight versus 2019, and new listings are down, so we're not building a huge inventory buffer. Demand is still soft on the 3-month view, and days on market are higher, so buyers have leverage at the listing level. Price reductions remain elevated, so sellers are still having to meet the market. Mortgage rates near 6% are the catalyst that could re-energize the spring market if they hold. At Pries Capital Real Estate, we track Myrtle Beach trends in real time and translate them into clear next steps for your specific neighborhood. If you're considering a move or you simply want to know what your home is worth, let's talk. You can visit us in Myrtle Beach or book a personalized consult. And to stay a step ahead, sign up for your free Pries Capital Real Estate research account at priescapitalrealestate.com for weekly, hyperlocal data and expert insights. Thanks for watching. I'm Tina Pries, and I'll see you next week.